Yo. It's your boy, the insurance junkie, your fiduciary fella, the all-star advisor, Alonzo Hall. And I'm here today to whap and tap on your head with 15 facts about IRAs. Before we go in, ladies and gentlemen, make sure you hit that like, drop a comment, subscribe, and hit that notification bell so you're made aware every time I release new content. And as always, share. Lastly, to contribute to channel growth, you can show support and hit that cash app. You can schedule a one-on-one appointment with a licensed financial professional, or you can purchase life insurance directly up to $1 million with an instant decision and no medical exam. The links are in the description. So, as we proceed to give you what you need, today I will be rolling out an article from Think Advisor in their savings and retirement section entitled Top 15 IRA Tax Facts to Know. I'm going to let it roll on for a few minutes, let some people roll in, and I'll be right back. Okay, there we go. Yo. It's your boy, the insurance junkie, your fiduciary fella, the all-star advisor, Alonzo Hall. Now return today to weapon tap on your head with another ADH Wealth solution. So again, today's article is Top 15 IRA Tax Facts that you should know. So, let's go ahead and start the slideshow. So, number one, what is an individual retirement account? An individual retirement account, or an IRA, is a written trust or custodial account created for the purpose of saving money for retirement that allows individuals to make yearly contributions up to specific annual limits that will grow tax-free. A traditional IRA allows an individual to make both pre-tax, where eligible, and after-tax contributions to the account, which will grow free of income taxes, but are taxable when distributed to the participant. Alternatively, a Roth IRA only allows after-tax contributions, but such contributions also grow tax-free and usually can be distributed tax-free to the extent they are considered qualified distributions. And that's fact number one. So I'm not going to be here long today. I'm here for a good time, not a long time, What is an individual retirement annuity? An individual retirement annuity is an annuity or endowment contract issued by an insurance company that is structured similarly to an individual retirement account, but must meet certain additional requirements to qualify as a retirement plan an endowment contract issued after November 6, 1978 will not qualify. Now, that's something different than a modified endowment contract, which is why there's always loopholes. But I tell you guys, these things are the same things. Don't listen to me. I don't write for Think Advisor, but it's a national publication. They can come closer than close. Yeah. We back. Salute, Wiley. Wiley, yeah, sub to the Wealth Talk Productions. Make sure most of the people that I'm in my chat, I'm subscribed to. We like a actual family in here. I need to get me some water. And I'm yawning. I'm going to do this real quick. Hop off and get back to some things. But what are U.S. individual retirement bonds? Prior to 1984, the IRC, Internal Revenue Code, provided for the issuance of retirement bonds. These bonds were issued by the U.S. government with interest to be paid on redemption. Sales of these bonds were suspended as of April 30th, 1982. Subsequently, the Treasury Department announced that existing bonds could be redeemed by their holders at any time without being subject to an early distribution penalty. Existing bonds can also be rolled over into other individual retirement plans under rules applicable to rollovers from individual retirement plans. And that's fact number 3. I don't know why my nose always clogs when I read facts to y'all. I guess that's because I get hoity-toity. Fact numero 4, or quattro, like the Audi. What is deemed IRA? What is a deemed IRA? Pardon me. A deemed IRA is an account or annuity created under an employer's qualified retirement plan. A deemed IRA is treated as a traditional IRA or Roth IRA and is subject to the same rules regarding contributions and distributions. Fact number 5, after an advertisement. What information must be provided to a buyer of an IRA? The trustee or issuer, i.e. the sponsor of an IRA, must furnish the plan participant with a disclosure statement and a copy of the governing instrument at least 7 days before the plan is purchased or established, whichever is earlier. Alternatively, the sponsor can wait to provide the disclosure statement to the participant until the time it is purchased or established, whichever is earlier, provided that the individual is permitted to revoke the plan within at least 7 days from that date. Moving forward. Okay. What, and this is fact 6, what is sequence of return risks and how it how can it affect a taxpayer's retirement income strategy? Hold on, let me just check the comments in the building. Caddick, Truth, salute. Wiley, salute. Make sure you hit that like, drop a comment, subscribe, and hit that notification bell so you're made aware every time I release new content. And as always, ladies and gentlemen, share. Lastly, to contribute to channel growth or support, you can hit that Cash App. You can schedule a one-on-one appointment with me, a licensed financial professional, or you can purchase life insurance yourself directly up to $1 million with an instant decision and no medical exam. The links are in the description. With that being said, as we proceed to continue and give you what you need. So, what is sequence of return risks And how can it affect the taxpayer's retirement income strategy? Like I said, man, I want younger men to look at me as an example. I want younger men to look at Chaotic Truth as an example. I want younger men to look at She We Here as an example. I want younger men to look at Daryl Long as an example. I want people to look at Conversations with King as an example. And I want people to look at what's his name? Anton Daniels as an example. I'm like Nas with this, right? Much success to you, even if you wish me the opposite. Sooner or later, we'll all know who the prophet is. At any rate, as we proceed to give you what you need. So, sequence of returns risk is a market volatility issue surrounding the order in which returns on a taxpayer's investments occur when the taxpayer is taking distributions or withdrawals from the portfolio. Essentially, if a greater portion of low or negative returns occur during the early years of retirement, the taxpayer's overall returns are going to be lower than if those negative or low returns occurred at a later point in the taxpayer's and the investment's lifetime. So fact number 7. When are funds in an IRA taxed? So actually this is good because this is good to look at the difference when you're looking at qualified and non-qualified retirement accounts and when you're looking at IRAs and Roths. So one of the benefits to Roths is you're paying what after-tax dollars. Now, the awesome benefit to that is that when you do get it annuitized, you're only going to pay capital gains taxes. Where on things like your 401k or an IRA that's taxed with pre-tax dollars, it does lower your current income tax. So if you have $100,000 on paper and you contribute $20,000, now you're only taxed on $80,000 of income. But when it annuitizes, they tax your capital gains as capital gains, but they tax your principal and any gains on that as regular income tax. And whatever income tax is at that point in the world. And we know income tax is just going to go up. So that's why people like to go with Roth IRAs or non-qualified annuities. By dumping more money into an annuity than you can into a qualified IRA. So, funds accumulated in a traditional IRA generally are not taxable until they are distributed. Funds accumulated in a Roth IRA may or may not be taxable on distribution. Special rules may treat funds accumulated in an IRA as a deemed distribution, and thus includable in income under the rules for traditional IRAs and for Roth IRAs. A distribution of a non-transferable, non-forfeitable annuity contract that provides for payments to begin by age 72, which is now the RMD, required minimum distribution, 70 and a half prior to 2020, and not to extend beyond certain limits, is not taxable. But payments made under such an annuity would be includable in income under the appropriate rules. So, when are IRA funds transferred between spouses or incident to a divorce treated as taxable distributions? So this is something that people should talk to with, we got attorneys in this space, Dennis Sperling and the lead attorney, but you know me, I'm blackity black, so I'm going to talk about Attorney Awesome, right? Brother Attorney Awesome BPM. Right? Because, like I said, the rest of the world seems to know how to make everyone assimilate them. Like our Star Trek fans who want the Borgs, who assimilate every motherfucking body into them. So when we look at people putting knees on our neck, and we will look at commercials like the doggone Little Caesars pizza commercial that tell the racist joke. See, there's a black woman in that commercial staring at the Little Caesars commercial saying, "Oh my God, I can depend on you, unlike my husband." And her black husband comes out with pizza and is like, uh-oh, Scooby. Well, see, I worked on Wall Street. I worked on 39 Broadway, right across from the Brass Bull, right across from HSBC Bank. I was the fly in the buttermilk at the stockbroker E.J. Sterling, where their holdings were at Stern AG. another holding company that has their money by Morgan Stanley held. And you know what these white people used to do? Oh, they used to call me all sorts of N-words. And you know what happened one day? They gave me a metal American Express black card and said, go to lunch on us. Because this white boy from South Africa called me a nigger to my face and said, hey, I'm from South Africa. I can do that. And you can't punch me in the face for that. They also used to tell racist jokes like, hey, Bob, what's the difference between a black man and a pizza? A pizza can feed a family of 4. A black man can't. Yeah, that shit hurts. Stop bickering amongst us, nigga. This is war. And it comes in all forms and facets. And I am never going to back down. And if you hear this, you're either with me or you're against me. Here's what it is. Salute, brother. Like I said, yo, get to the tweeting. I used to do that perfect back when I wanted, what was his name? Steve McNair to sell the Texans. I was tweeting Donald Trump as real estate Zoe. Force him to sell like you did Donald Sterling. Force him to sell. I did that shit for 2 years straight by my goddamn self. I don't just talk about it, I actually live it. That's why I'm not an internet nigga. I don't really do this internet shit, but let me get back to this because I'm educating y'all. I'm just passionate about this, man. Babe, can you bring me a bottle of water? Thank you. So, when are IRA funds transferred between spouses or incident to a divorce treated as taxable distributions? Thank you, bro. An individual may transfer without tax the individual's IRA to his or her spouse or former spouse under a divorce or separate maintenance decree or a written instrument incident to the divorce. The IRA then is maintained for the benefit of the former spouse. Any other assignment of an IRA is a deemed distribution of the amount assigned. Russell indexes. Your index matters. So, fact number 9. Are IRA distributions subject to the 3.8% net investment income tax? Distributions from traditional and Roth IRAs are not subject to the 3.8% net investment income tax, also known as the Medicare contribution tax, imposed under the Affordable Care Act. The tax equals 3.8% of the lesser of a taxpayer's net investment income for the taxable year, or the excess, if any, of the taxpayer's modified adjusted gross income for the year over a threshold amount of $200,000 for a taxpayer filing an individual return and $250,000 for a taxpayer filing jointly. IRC Section 1411 specifically excludes distributions from both traditional and Roth IRAs and other qualified plans from the distribution of net investment income. Excuse me. I had them spicy Doritos. They got my sinuses tingling. So, how are earnings on an IRA taxed? I was speaking about this prior. So an IRA offers tax-free buildup on contributions. The earnings on a traditional IRA are tax deferred to the owner. That is, they are not taxed until the owner begins receiving distributions. The earnings on a Roth IRA may or may not be taxed upon distributions. Like a trust that is part of a qualified plan, an individual retirement account is subject to taxes for its unrelated business income. Tax deferral is lost if an individual engages in a prohibited transaction or borrows under an individual retirement annuity. Excuse me. The loss occurs as of the first day of the tax year in which the prohibited transaction or borrowing occurred. For an account established by an employer or association of employees, only the separate account of the individual loses its deferred status. And that was fact 10. So before we proceed to give you what you need, ladies and gentlemen, make sure you hit that like, drop a comment, subscribe, and hit that notification bell so you're made aware every time I release new content. And as always, share, share, share. Lastly, to support channel growth, support by hitting that Cash App. You can schedule a one-on-one appointment with me, or you can purchase life insurance directly up to $1 million with an instant decision and no medical exam. The links are in the description. Again, you can support the channel growth by hitting that Cash App. You can schedule a one-on-one appointment with me, or you can purchase life insurance directly up to $1 million with an instant decision and no medical exam. The links are in the description. One more time for the people in the back. You can purchase life insurance directly by clicking the link in the description. You can schedule a one-on-one appointment with me by clicking the link in the description. Now, as we proceed to give you what you need. One second. Hold up there. I got something going on my phone. Actually, I should go to the Group Me joint too. Now, fact number 11. Who may establish Who may establish an IRA? Virtually any individual who wishes to do so may establish a traditional IRA. To deduct contributions to such a plan once it is established and avoid tax penalties for excess contributions, an individual must have compensation, either earned income of an employee or self-employed person, or alimony prior to 2019 and before 2020, must have not attained age 70 and a half during the taxable year for which the contribution is made. The Secure Act repealed the age limit on IRA contributions. Fact number 12. When must contributions to IRAs be made? Contributions to both a traditional IRA and Roth IRA must be made by the tax filing deadline for the tax year in question, not including extensions. For example, a taxpayer who wishes to contribute to an IRA must do so prior to April 15th, July 15th in 2020 of the following year. This rule applies whether the IRA is an existing or new plan. With respect to traditional IRAs, contributions may be deducted for that tax year if the contribution is made on an account of that year. This applies to both contributions to individual plans and contributions to spousal plans. A postmark is evidence of the timeliness of the contribution. Hold on there a second. Damn, I'm mad nasal right now. I don't know why I'm getting nasal when I go on the daggone live. It's crazy, right? Let me see here. Fuck it though. So let's see here. So now let's move on to fact number 13. Fact number 13. What is the difference between a Roth IRA and a traditional IRA? The primary difference is the tax treatment of contributions to and withdrawals from the account. Qualified distributions from a Roth IRA are not includable in gross income. Thus, earnings are tax-free, not tax-deferred, as is the case with traditional IRAs. Any non-qualified distribution from a Roth IRA will be includable in income, but only to the extent that the distribution, along with all previous distributions from the Roth IRA, exceeds the aggregate amount of contributions to the Roth IRA. People Magazine, get your copy today. So, fact 14. Who is an active participant for purposes of IRA eligibility rules and deduction limits? So, suppose an individual is an active participant in 1. A qualified corporate or KEO plan, profit sharing, stock bonus, or annuity plan. 2. A simplified employee pension or simple IRA. 3. A Section 403B tax sheltered annuity. Or 4. A government plan. In those instances, the individual's deduction limit for contributions to a traditional IRA may be reduced or eliminated. The limitation applies if the individual or their spouse was an active participant for any part of the plan year that ended with or within the taxable year. So we're going to do a second article because I don't know how long I've been going now. I've only been going for less than a half hour. Oh, shit. I wasn't trying to skip to the next. I hate when this does that. Hold on. Why you skip? Alright. So, now, fact 15. When can IRA contributions be withdrawn or reduced? A taxpayer who wants to withdraw or reduce a contribution, whether to correct a problem, such as an excess or impermissible contribution, or merely because the taxpayer has changed his or her mind, generally may do so without recognizing income tax or penalties. If the contribution is withdrawn, together with the net income attributable to such contribution on or behalf the due date, including extensions of time for filing the federal income tax return of the contributing individual, the amount distributed will be treated as if never contributed, regardless of the size of the contribution. Thus, such a distribution is not included in gross income and is not subject to the 10% early distribution excise tax. A distribution of an excess contribution also is not subject to the 6% excess contribution excise tax. Moreover, no income tax deduction may be taken for such a contribution. So, actually, you know what? We should read this article, which is RMD Facts. But I don't think I have anybody who's currently in that situation personally, right? But guess what I do have? I have a bunch of people who have estate issues with their parents, right? I have people who are in their 40s and 50s who have, advisors embrace the future, offer your clients crypto. Yeah, now they're actually trying to get us to offer our clients crypto, which is something that, a lot of us aren't embracing, but as you can see, they're telling us to offer it to you. So that's why you'll see us kind of looking into it a little bit. But the regulation that we know that's going to come onto it, that's kind of why we're not heavily into it. So anyway, we won't talk about spiders right now. That's an internet algorithm. But you know what? I think that is a good fact to hop onto. Is the required minimum distribution, because we have people who have parents and grandparents, and we're handling their affairs. And in handling their affairs, we have to know things like, well, what happens when grandma turns 72? What happens when grandma turns 85? Why don't all of us have life insurance on Uncle Joe? Uncle Joe is 84 years old. This man been around for a while. Now, he could live another 22 years. Or not. But this is things that other communities are coming together, pooling their money together. And instead of when somebody dies, we got to pool our money together to bury them. We could be pooling our money together. Let's say it's $500 a month, but we got 15 family members who can benefit from $1 million policy off of the eldest family member. Boom. So, we're going to look at the top 12 required minimum distribution tax facts. Well, there's an advertisement here from Nationwide Insurance. And it says, we simplify how to use life insurance as a tax-efficient income solution. I can definitely show you that. So hit my link and schedule an appointment. So, as we proceed to give you what you need, the top 12 required minimum distribution tax facts you should know. So, number 1. What are the minimum distribution requirements for IRAs? Well, amounts accumulated in an individual retirement account or annuity must be distributed in compliance with the minimum distribution requirements. The amount that must be distributed each year according to the rules is commonly referred to as the required minimum distribution, or RMD. For the calculation of lifetime RMDs, see Q3686 for after-death distributions, or Q3687 reporting requirements pertaining to IRA required minimum distributions are planned in Q3597. Roth IRAs are not subject to the lifetime minimum distribution requirements, but are subject to the after-death distribution requirements explained in Q3687. Those are legal documentations that advisors need to know. What can be done before the IRA required beginning date in order to minimize RMDs? So many individuals can reduce their RMDs by converting a portion of their traditional IRA funds into Roth funds. Roth IRAs have no minimum distribution requirements. Unfortunately, if the taxpayer is still working, the taxpayer may still be in a high enough income tax bracket that the taxes generated by the rollover can be substantial. All amounts rolled over from a traditional IRA to a Roth IRA are taxed at the owner's ordinary income tax rate. If the individual is still working, the taxpayer can also consider rolling the funds into a qualified plan, such as a profit sharing or 401k plan, where the distributions are not required until the later of the year the taxpayer turns 72 or the year the taxpayer retires. So, fact number 3. Is there a penalty for failure to comply with IRA RMD requirements? A penalty tax is imposed on the participant IRA owner if the amount distributed under an IRA for a calendar year is less than the RMD for the year. The penalty is equal to 50% of the amount by which the distribution made in the calendar year falls short of the required amount. The penalty generally will be imposed in the calendar year in which the amount was required to be distributed. If the distribution was the first required distribution, and thus was due by April 1st, following the calendar year in which the IRA owner reached 72 years old, the required beginning date, the penalty will be imposed in the calendar year when the distributions were to begin, even though the required distribution was technically for the preceding year. Fact number 4. How are the minimum distribution requirements met during an IRA owner's lifetime? Distributions from a traditional IRA or annuity must begin by April 1 of the year after the year in which the owner reaches age 72, whether or not the owner has retired. Traditional IRA owners working beyond age 72 are not permitted to delay distributions until after retirement, even under an employee-sponsored plan such as an SEP or simple IRA. Unless the owner's entire interest is distributed on or before the required beginning date, distributions of the balance must begin by that date. Russell indexes. Your index matters. So the Russell 2000 is what they're talking about. I know most people are familiar with the S&P 500. We can help simplify meeting clients' insurance needs. I guess they're telling you that, as you can see, well, you're not going to see the ad again. Well, I guess you are. What the heck? Yoga. My computer. Yeah, StreamYard be sucking energy from your computer, huh? Jesus. The notorious. Alright. Let's see. If I can get to fact 5, I think. Here we go. Yes, fact 5. What about inherited IRAs? Under the Secure Act, IRAs inherited by most non-spouse beneficiaries after January 1, 2020 must be depleted within 10 years of the original account owner's death. Before this law was enacted, inherited IRAs generally allowed an individual to stretch the tax deferral associated with these accounts by providing for distributions of the account value over a period of years following the original account owner's death. Under the Secure Act, this strategy is only available to eligible designated beneficiaries, including the account holder's minor children, until they have reached the age of majority, which in most states is 18. Beneficiaries who are less than 10 years younger than the account holder who are chronically ill or disabled, and certain trusts. What is the difference between a spousal inherited IRA and a non-spousal inherited IRA? What do taxpayers need to be aware of with respect to the differences between these types of accounts? The primary difference lies in the requirements that apply with respect to the RMDs. After the original account owner's death, a spouse who inherits his or her deceased spouse's IRA is essentially entitled to treat the IRA as though it was their own. This can potentially allow a younger beneficiary to delay taking RMDs until that individual reaches age 72. What differences exist between the treatment of an inherited IRA and inherited 401ks? So while inherited IRAs often may be distributed over time, potentially spreading the associated tax liability over time, qualified plans, such as 401ks and profit-sharing plans, are subject to a different set of rules that do not allow the funds to be distributed over time. When a taxpayer inherits a 401k, the funds typically must be distributed immediately in a lump sum payment, resulting in an immediate tax liability for the beneficiary. Most plans will specifically require lump sum distribution treatment because of the administrative burdens associated with allowing stretched out distributions. Despite this, certain beneficiaries can roll those funds into an inherited IRA. And that's fact number 7. Fact number 8. Are inherited IRA funds exempt from the claims of a taxpayer's creditors in bankruptcy? So, many have disagreed on this issue in the past, but the Supreme Court provided clarity in 2014. Under current law, the funds in an inherited IRA are subject to the claims of a beneficiary, debtors, creditors, and bankruptcy. If the account is inherited by a beneficiary who is not the original account owner's surviving spouse, traditional and Roth IRAs that are not inherited accounts are typically exempt from bankruptcy claims up to an inflation-adjusted $1 million limit. Hold on. Which is adjusted every 3 years. The exemption as of April 1, 2019 is $1,362,800. And we've got another advertisement. Get your Centrum Silver products here. And HBO Max, Sex and the City comes back. All right. Fact number 9. Who is a designated beneficiary for purposes of RMDs from an IRA? A designated beneficiary is an individual or a trust meeting certain requirements designated as a beneficiary, either by the terms of the IRA plan document or by an affirmative election of the IRA owner, such as owner's surviving spouse. The designated beneficiary need not be specified by name to be a designated beneficiary, so long as that beneficiary is identifiable under the terms of the IRA as of the determination date. So, what are an IRA trustee's reporting requirements with respect to RMDs? 2 reporting requirements are imposed on IRA trustees. 1 to the IRA owner and 1 to the IRS. For IRA owners, 1, if a minimum distribution is required with respect to an IRA for a calendar year and the IRA owner is alive at the beginning of the year, the trustee that held the IRA as of December 31st of the prior year must provide a statement to the IRA owner by January 31st of the calendar year. The statement must satisfy one of the following alternatives. 1, it must inform the IRA owner of the amount of the RMD and the date by which it is required. 2, it must inform the IRA owner that a minimum distribution is required with respect to the IRA and offer to calculate the amount of the distribution on request by the owner. So fact number 11. What IRS filing requirements does an individual retirement plan participant have to meet? So an individual who establishes an individual retirement plan does not have a filing requirement other than what is reported on the individual's 1040. For any year in which there is no plan activity other than a recharacterization or, the making of contributions other than rollover contributions and permissible distributions. However, an individual does need to file Form 5329 with their tax return if there is any tax due because of an early premature distribution, excess contribution, or excess accumulation. Moreover, a separate form also is required when non-deductible contributions are made to an IRA. And now we go to fact number 12. May an employer contribute to an IRA on behalf of an employee, and may an employer or union establish an IRA for its employees or members? So the answer to that is yes. An employer may contribute to a traditional to a traditional or Roth IRA of any eligible employee or an eligible spouse in some cases. Any contribution made by the employer must be included in the employee's gross income as compensation for the year for which the contribution was made. The employer's contribution is treated as though made by the employee and subject to the maximum contribution limits applicable to individual retirement plans. If the contribution is made to a traditional IRA and the employee is eligible, the employee may take a deduction subject to the limits in. The employer subject to the limits in. The employer deducts the contribution as salary or other compensation and is not as a contribution to a retirement plan. Because amounts contributed by an employer are compensation to the employee, they are subject to FICA, Social Security tax, FUTA, federal unemployment tax, and income tax withholding. So that's the 12 facts about required minimum distributions and their tax effects that you should know. So we have some last-minute tax preparing tips for 2021. I might take a look at that. We got 15 top tax havens around the world. Let me see. Anybody in the chat right now? No. So I can pick anything I want for the next 15 minutes. All right. So then if that's the case, I am going to look at Ed Slott's 10 last-minute tax and retirement tips for 2021. And then I'm going to hop off this. So, Ed Slott's 10 last-minute tax retirement tips for 2021. Ladies and gentlemen, make sure you hit that like, drop a comment, subscribe, and hit that notification bell so you're made aware every time I release new content. And as always, share, share, share. They're trying to get me to be wealth partners with them. Learn more about selling your business. This is if you want to sell your book of business to another advisor. So I'm going to close that advertisement. So I thought I was starting the slideshow here. Okay, so let's start the slideshow now. So, Ed Slott's 10 last-minute tax and retirement tips for 2021. Number 1 is to follow up on IRA and 401k transactions like rollovers, Roth conversions, and backdoor Roths. Make sure these funds actually go to the correct destination. We're seeing lots of errors here, maybe due to shortages of staff at financial institutions, clicking the wrong account online, or sloppiness in general. This will probably get even worse in a week or so as more staff might be taking time off for the holidays. Many of these transactions are just not followed up on. If they don't go to the right place, it can be a real mess trying to fix up later after the year has ended and the tax reporting is already set in stone. In a recent case, Roth 401k funds were erroneously deposited into a traditional IRA, which you cannot do, and you would never want to do anyway. These funds were already taxed. They were supposed to be rolled over into a Roth IRA, but they went into the wrong IRA. The financial advisor never followed up. The client ended up requesting this expensive private letter ruling from the IRS for relief. The PLR fee alone was $10,000 or $10,000 on what should have been a tax-free rollover. So yeah, these are the type of things you don't want to really wait until the next year. You want to finish them up in this calendar year. So any folks that I've been doing transactions with on setting up those annuities, let's finish that up this year, so you don't have too many crazy tax implications going into next year, or have to deal with extra tax implications. If you're making more money next year, you can already be contributing to something as opposed to looking like you're trying to shelter tax dollars. So tax tip number 2, follow up on 60-day rollovers. Were the funds deposited within 60 days? This includes Roth conversions. Follow up on a backdoor Roth transaction. The first step in the process is to make a contribution to a traditional non-deductible IRA and then convert those funds to a Roth IRA. Were the funds ever converted? Included in the recent tax proposal is a provision to eliminate both the backdoor Roth and the mega backdoor Roth after this year. So if your clients want this, they should get this completed before year end, like December 24th. 3, how much will that Roth conversion cost? So this is actually tips for advisors as opposed to tips for clients. So y'all are learning some real backdoor stuff. So how much will that Roth conversion cost? Help clients with accurate tax projections. Most of the 2021 income is known by now, so you'll be able to get a better estimate of what the tax bill might be on the 2021 Roth conversion. It's good to get the CPA or other tax preparers' input on this. To qualify as a 2021 Roth conversion, the funds must leave the IRA before year end. Check the effect of a Roth conversion on a Medicare IRMAA surcharges too. Remember, there is a 2-year lockback on these. Contacts clients who lost a spouse this year. Next year, the survivor will likely be filing single, increasing their tax bill. Consider a Roth conversion before year end to get the income into that final joint tax return. Damn, he's really looking to help people out here. It's chitty chitty bang bang stuff. Okay, so 4, don't forget business income when planning Roth conversions, right? So what does that mean here? Well, why is my damn? So when calculating income, make sure to include any business income or losses from clients with pass-through income from S Corps, LLCs, partnerships, and Schedule C income. Check if the planned Roth conversion might affect eligibility for the 20% QBI, qualified business income deduction. A Roth conversion could push income over the limits and knock out the deduction, or in some cases where taxable income is low, a Roth conversion could increase the QBI deduction. That's fact number 4. So fact number 5 coming up. Let's see what we got in the chat. Big data. Leverage big data for your marketing. Yeah, this is Think Advisor is actually pointed toward advisors, so a lot of the advertisement they have is, towards actual advisors, independent advisors like myself. So tip number 5, take those RMDs. They're back. The CARES Act waived required minimum distributions, but only for 2020. Make sure your clients have taken their 2021 RMDs. We are still hearing from people who think this RMD waiver still applies. It doesn't. Not only that, many clients' 2021 RMDs may be higher since no funds had to be withdrawn last year. Plus, the market was up last year. Make sure they have enough tax paid in wither-through estimates or withholding to cover the tax bill. Tip number 6. You want to make sure that heirs take RMDs if needed. So take note of which beneficiaries will be subject to RMDs. There are 2 payout schedules to keep track of for non-spouse beneficiaries like children, grandchildren, and trusts. Beneficiaries who inherited before 2020 can still use the stretch IRA. They simply resume their schedule. The 2020 waiver has no effect. Beneficiaries who inherited in 2020 or later will likely be on the 10-year rule. No funds have to be withdrawn until the end of the 10th year. But if tax rates are low this year, it might pay to withdraw some of the funds this year, but not from inherited Roths since those are tax-free. So, tip number 7. Net unrealized appreciation tax planning for lump sum distributions. So the combination of red hot stock market in 2021 and retirements may make 2021 a banner year for those clients who qualify for the NUA tax break. Excuse me. This can turn what would otherwise be ordinary income into preferable long-term capital gains. This applies to those with company stock in their 401k. If they have a triggering qualifying event, such as separation from service or reaching age 59 and a half, or death or disability, they can take a lump sum distribution and only pay tax on the cost of the stock when acquired in the plan. The stock would be transferred in kind as stock to a taxable brokerage account. Other non-company stock plan assets can be rolled over into an IRA tax-free. The tax on the cost of the NUA stock will be at ordinary tax rates, but the appreciation will be taxed at long-term capital gains rates, but only after the stock is sold. Fact 8. Consider qualified charitable distributions, or tip 8. So most clients get no tax benefits from their charitable gifts because most taxpayers use the higher standard deduction. QCDs provide a better tax break by allowing direct gifts from IRAs. The distribution is excluded from income and can satisfy an RMD. But the QCD break is only available to IRA owners and IRA beneficiaries who are age 70 and a half or older, and it's limited to $100,000 per year per person. Donor-advised funds don't qualify for QCDs or mega QCDs. Tip 9, coming up. Leverage big data for your marketing. Click here, advisor, so you can market to many motherfuckers. 9, ending soon, mega QCDs. This break ends this year. Last year's Stimulus Act increased the deduction limit for cash contributions to 100% of adjusted gross income. This can allow a large distribution from an IRA or 401k to raise AGI and allow a larger contribution deduction. This can work for those who don't qualify for the QCD or those who wish to give more than $100,000. Don't do this before age 59 and a half, or it could trigger a 10% early distribution penalty. And finally, tip 10, avoid the number one mistake, not checking beneficiary forms. Check these for every plan, IRA, annuity, and life insurance policy. There's been a lot of transition just over the past 2 years. Plans may have changed. Ask clients about events in their lives like deaths, marriages, divorces, remarriages, births, new grandchildren, change in tax laws. We've had it all. Beneficiary forms must be reviewed and updated. For example, after the Secure Act eliminated the stretch IRA for most non-spouse beneficiaries, clients who named a trust as their IRA beneficiary will likely find that this plan won't work anymore. Always check beneficiary forms if a beneficiary is disinherited, which often happens after a divorce when the beneficiary form isn't updated. Then, that is the same as a 100% tax. You don't want to be there when this happens, especially if it happens on your watch. So, ladies and gentlemen, that's it for today. Make sure you hit that like, drop a comment, subscribe, and hit that notification bell so you're made aware every time I release new content. And as always, share, share, share. Lastly, you can contribute to channel growth by donating or showing support and hitting that Cash App. Again, you can show support by hitting that Cash App. Again, you can show support by hitting that Cash App. You can schedule a one-on-one appointment with a licensed financial professional, which is myself. And you can purchase life insurance directly up to $1 million with an instant decision and no medical exam. The links are in the description. Again, you can support channel growth by hitting that Cash App. You can schedule a one-on-one appointment with me, a licensed financial professional. Or you can purchase life insurance up to $1 million directly with an instant decision and no medical exam. The links are in the description. With that being said, ladies and gentlemen, make sure to wipe ass. Work in progress every day and see success. Wipe ass. Work in progress every day and see success. Wipe ass. Work in progress every day and see success. And remember, ladies and gentlemen, when people challenge you, they don't challenge you to challenge you, but they challenge you to challenge you. Accept the challenge. Salute.